Now, in my last update, I talked about how the weekly charts were confirming or getting the fall through, I should say, of the topping tail. We had confirmation of that, then we're getting the fall through. And with that, so again, here's the confirmation bar right here. And now we're getting the follow through. And with that, we're seeing the bars turn back to red in the weekly time frame. We're dropping and closing below the 10-week moving average. And we're getting the bearish reversal of conditions in that we're taking out the lower boundary of the cloud. So as we start next week, the cloud will now be red like we had back over here. And the warning signs with the awesome oscillator in the weekly time frame starting to turn red. We've got the warning reversals for slamming into major resistance. So I talked about all of these things in the weekly time frame, and I addressed the daily charts as well and covered intraday charts. And again, I think we're eventually moving back towards the April low and towards our 200-week moving average. In order to have a bear market, you've got to come down and eventually take out the 200-week. I think you're going to come back down towards it, or just above it, or to it, and test this low. There's a channel line that we could find support at above this April low over here. But then I think you're going to get that right shoulder that I've talked about, and I think you get a massive rally, and I think it's going to be more, of a sell-off into January. As I said, I think you're going to be selling off into January, and I think that in January you're going to be down here near these areas, the 200-week, down towards the April low, towards the upper channel or the lower channel line. You'll drop 26-30% or so, and then I think that we're going to rally back up big time and get that right shoulder that I've talked about, rally back up. Again, this was 61.47 was the high over here. I think you're going to rally back up towards the 50-week moving average as it's starting to tilt downward. And eventually, I think you'll confirm the bear market by closing below, pushing back below the 200-week moving average. Now, same thing going on with the NASDAQ, but we've got that broadening formation. And again, 200-week moving average down here near the April low. I think that's where we're headed. And again, if we bounce, you'll get that partial rise as we do with broadening formations, as I've talked about. We'll give the S&P the right shoulder, and that will give possible head and shoulders for the NASDAQ if evolves into that. But right now you have that broadening formation on both NASDAQ and NVIDIA. As I've said, if we get the sell-off immediately, and this is NASDAQ weekly chart, if we get the sell-off immediately, we got to take out these 200-week moving averages. If we try to bounce, you buy a little bit more time, you can rally back up and still have the signals bearish here in the weekly time frame. Try to rally surrounding Thanksgiving and then drop, but we're following Bitcoin's lead. If you want to see my latest Bitcoin video, I'll link that at the end of the video. But Bitcoin is about to confirm bear market. Stock market's going to play catch up to Bitcoin. Bitcoin's crashed 36%. They have a positive correlation. The sell-off with Bitcoin's not done. It's going to end up dropping probably over 50%. That's what it usually does at bear markets. And it's only dropped 36%. That's what it usually does to kick off a bear market. Stock market, to kick off a bear market, usually crashes by 20% or more, right around 20%. I expect we're going to get a bigger crash on NASDAQ and S&P. This was 26% over here on the S&P. This was 21%. I expect we're going to get a bigger crash than those crashes. So I expect NASDAQ's going to probably drop well over 30%. And when it kicked off the bear market, with the bursting of the tech bubble, it dropped over 40%. So I think you're going to see something similar to that, moving back towards these 200-week moving averages. Please support the channel with the link directly below. That allows me to be able to provide you this information. Most YouTube channels get sponsors. They contact me all the time. I turn those offers down because I don't want to sell you anything. I need to hear from you in order to make it work. If you could partner with me and follow the link below, it'll take you to a secured site and you can donate any amount you want. Anything helps. If you could take a moment to do that, I would really appreciate it. If you could step up to the plate and help out this weekend, I would really, really appreciate that. I thank you for your consideration for that. Watch the video all the way through. I'm going to be talking about these long-term charts. I'm going to be talking about what will define the bear market? Talking about the long-term moving averages and the warning signs in the weekly and the monthly time frame. Watch the video all the way through. Bitcoin is going to confirm a bear market. The 50-week moving average has held as support, the green line. Bitcoin closed below the 50-week moving average, and it's now getting an open and close below the 50-week moving average. It closes the week out on Sunday, and which is today when you're listening to this video. If Bitcoin confirms a bear market this week, which I think it's going to do, I think it's unlikely that it's going to rally back above the 50-week moving average after dropping 20% here in the last, over 20% in the last 2 weeks. Bitcoin is going to confirm a bear market. It's now dropped 36%. It's going to end up dropping 40 or 50%, probably over 50% like we did over here to kick off the bear market and then rally back towards the 50-week. The S&P is going to do the same thing. It's going to drop below the 50-week, go down to the 200-week moving average, and then rally back up to the 50-week moving average. Bitcoin confirms a bear market this week. The stock market is right behind it. 2021, Bitcoin peaked, and the market peaked right after that with NASDAQ. Later, the S&P made a new high and peaked shortly thereafter in January. I don't think that happens again because I think S&P slamming into major resistance, as you'll see in this video, and I think S&P is now NASDAQ Junior, so I think it's already topped and it's not going to go make new highs. This is a huge warning sign to you that, again, Bitcoin's confirming a bear market like we did back over here the last time around when we had the 2022 sell-off for the stock market and Bitcoin moved into the bear market and dropped 78.5%. Show you what I'm looking for as far as the 200-week and the 50-week moving average with the bear market. But again, we're likely about to get a significant drop in the market and play catch-up to Bitcoin. It's not done with the sell-off. And again, Bitcoin's forming a massive head and shoulders. So is the S&P 500. Bitcoin's probably going to take out this low and do something like it did over here with a slanted neckline. And you're probably going to see the head and shoulders form on the S&P and a head and shoulders form on Bitcoin, but it'll probably take this low out. That's only a 41% drop. Historically, Bitcoin drops about 50%. This was 52%. And again, that would take Bitcoin to 60 or 63,000 if it does what it did previously, or if it drops 50% down to 63,000. So just be aware of this. This is telling you, hey, the stock market is going to follow Bitcoin's lead. They have a positive correlation. The asset with the most volatility, Bitcoin, it peaks first. It peaked on October 6th, ending the 4-year cycle right on the nose. The NASDAQ and the S&P peaked on October 29th, a few weeks later. This is what it's done in the past. Wouldn't be ignoring what's going on with Bitcoin. Watch this video all the way through if you want to be in the know, looking at the long-term charts. Talked about it briefly in my last video, a lot of the sell signals that were forming. I want to show you the monthly charts, but again, regarding the 200-week moving average and the 50-month moving average, these are the levels that need to be taken out to enter a bear market. I do think the divergence has created a top on the price oscillator. And again, if you had just had the MACD, you'd never know it. The MACD is moving above the previous highs. The diversions back over here that formed going into the February top, you got it on the MACD, but then you went and made a new high. Again, I like the price oscillator so much better than the MACD, which is based on moving averages. But the weekly time frame, if I just clear everything, this is the green line is a 50-week moving average. The black line is a 200-week moving average. You got the people telling us, oh, we've already had the bear market. That's already over with. This isn't going to start a new bear market. We're not starting one right now. You can't have one. We're only 3 years into the new bull market. And again, people that are telling us that are the people that told us the 2022 sell-off wasn't going to happen. They told us there was no risk of downside, no sell-off that's coming. And again, we had crashes, and now they're saying, oh, that was 27.5%, so that was the bear market. Poppycock. That's baloney. Because again, you've had in this long-term bull market, you've had many drawdowns of 20% or greater. 2011, 21%. 20%, 2018, 5% in 2020, 27.5%. You've had these drawdowns and you haven't really been able to take out the 200-week moving average. You took it out briefly here with the crash with the pandemic over 3.5 weeks. Oh, this was a bear market. Well, was that the shortest bear market in history where we crashed 35% in 3.5 weeks? Does that make any sense to you? So again, we dropped below the 200 week, we got back above it, and it ended the crash. Have found support, got back above the 200 week after the bear market ended. You eventually got back above it. You found support at it. You found support at it here in 2016. You found support at it here in 2018, just below it, got back above it there in 2020. You found support at it here in 2022, and you came to just above it there in 2025. In order to have a bear market, you got to take out the 200-week moving average, the black line here. When we had the bear market back over here and back over here, eventually, with the bursting of the tech bubble during the financial crisis, you drop below the 50-week moving average and you stay below it. You drop below the 50-week moving average, you stay below it, the green line. And eventually you drop below that 200-week moving average and confirmed bear market by being below, remaining below the 50-week moving average and having price drop below the 200-week, the black line over here and over here, it confirmed the bear market, and all the while you held below the 50-week moving average, which is almost equivalent to the 200-day moving average. The 200-day is really between the 50-week and the 40-week moving average when you look at the conversion. The conversion from the daily time frame to the weekly time frame. Usually it hovers right in between those two moving averages. Conversion might be a little bit closer to the 40-week moving average, but if you look where they are on the chart, 200 period is usually hovering somewhere between wherever the 40-week and the 50-week moving average are in the weekly time frame. So again, if we take out the 50-week right here, again, I think you're going to move back to the 200-week. What do we do right here? We took out the 50-week. What do? We went back to the 200-week, and what do? We bounce. If I just bring this up close, you can see what happened in the previous bear markets. And again here in 2000 we peaked, eventually started dropping, and again the Fed eventually responded with jumbo cuts with both of these drops. By the way, I believe the rate cut started in January of 2001 with this drop. I believe that's when it started. The Fed was late in both of these cases cutting rates, and I think that they're late right now. But if you look at this, again, you had this 20% drop, and then you rebounded. You dropped below the 200-week, and you rebounded back up to the 50, and then you got the bigger crash. And again, that kicked off the bear market. Over here, you came down to just under the 200-week, and you rallied back up to the 50. In both of those cases, you've rallied back up to the 50-week moving average. So I think that's reasonable to believe that we're going down to kick off the bear market to the 200-week moving average. That's what you've done in the past. You've kicked off the bear market by dropping to the 200-week moving average and trying to bounce off of it. And the bounce took you back to the 50-week, and then you got the collapse under the 200-week moving average, and getting rejection off the 50, held below it, it acted as resistance. Again, dropped below it, acted as resistance. Again, you held below that 50-week and the cloud, the trending cloud, by the way, all the way down. So I think it's reasonable to believe that, and let me just zoom back out here to our recent price action here for today in 2025. I think it's reasonable to believe that if you move to the 200-week moving average just beyond it here to kick off the bear market, and you move to just beyond it here to kick off the bear market, just a little bit deeper here in the bursting of the tech bubble, I think it's reasonable to believe you're moving to the 200 period. I called a top on October 29th. I still think we've topped into major resistance. I see evidence in the monthly time frame and the weekly time frame that a sell-off is about to happen, and again, likely to kick off the bear market. Fed has started cutting rates. That's a warning sign right there. That's been associated with these past bear markets over here, and ending quantitative tightening. Again, I think a recession will start in December or January. We won't know that until deeper into 2026, probably at the very end of 2026, they'll declare the recession started on such and such date. My guess is it's going to be December or January. I think the stock market is beginning to price that in. Bitcoin has already dropped 36%. It's going to confirm a bear market this week. The weekly charts on Bitcoin are confirming the 4-year cycle is over. The last time we had the 4-year cycle end with Bitcoin, we had a 27.5% sell-off on the S&P. Bitcoin moved into a bear market and dropped 78.5%. If the stock market moves down to the 200-week moving average, bounces, goes back to the 50, and then collapses, Bitcoin's probably going to drop 80 or 90%. We've never had a bear market with the stock market where we lose the 200-week moving average. Well, Bitcoin has existed. These bear markets, Bitcoin didn't exist. I'm just telling you that the stock market has peaked, as I believe it has, and we're turning off major resistance, which we are in the weekly time frame. The long-term monthly chart, we're turning off the long-term 100-year trend line. If that plays out, that we come down, it's reasonable to believe we're moving to the 200-week moving average as we did over here and just overthrew it, and here just slightly under it, and then we rally back up big time to the 50-week moving average. So if we do that, let me just bring it up close. You can form this head and shoulders pattern back towards the 200-week, back up, and again, the 50-week is still rising right now. Over here, when we began to sell off, it was still rising. And then finally it flattened out and began to fall. And eventually you rose back towards it. Here, overthrowing it, here, back up to it. Now that was a major correction in the longer term bull market. This is going to kick off the bear market. That's why I keep saying the crash we're about to get is going to be bigger than the crash, the 21% crash over here, which was corrective, an ABC move. This one is going to kick off the bear market. We're not going to go back and make new highs. This is going to come back and we're going to get a rally. And again, Bitcoin's setting up the same head and shoulders pattern. The stock market now has to play catch up. We take out the 20-week moving averages, as I talked about, we can get the bigger sell-off right here, right now. If you rally and then sell off, maybe you get that right shoulder I talked about in my last update, and I've talked about all last week. But this is what is likely going to happen, this larger head and shoulders pattern. And now we have the divergence on the RSI. We have the price oscillator and the MACD, and the different oscillators are rolling over. Now we've got the divergences starting to play out in the monthly time frame, will likely take us back to the 50-week, take us back eventually to the 200-week, and you'll likely see this happen. And again, if we drop below the cloud, you come back up to it, it's going to be resistance. You drop below the cloud, it came back up to it, it was resistance. So again, in order to have the bear market, you got to take out the 200-week in the weekly time frame. You got to take out the 50-month in the monthly time frame. Now, if I just draw it in here, you can see again what I'm looking for. If this pattern plays out, this head and shoulders pattern, it measures to being able to go take out the 2022 low and moving back towards the 2020 low. I think it will play out. Some things to be aware of in the weekly time frame. We're likely going to move back towards the 200-week moving average, bounce off of it, and eventually move back towards this 50-week moving average and towards the cloud. They'll become resistance, and then again, I think that will happen in January because I think that we're going to see the market drop. I think the Fed is going to freak out. So let me move my trend line right here to January. I had overthrown that going in the first quarter a little bit, but I think you're dropping into January, and then I think you're going to get this rally back up into March or April or something for a couple of months. I think you'll get a couple of month rally, a couple of months of a rally to get the right shoulder back to the 50-week moving average, wherever it is. That's what we've done at other bear markets. I think it's reasonable to believe you move back, you get a crash to the 50 or maybe beyond it. As we did the last two bear markets, you move beyond that 50-week moving average, that 200-week moving average, and then you rally back to the 50-week moving average in the cloud. I think it's reasonable to believe we're going to do the same thing again. If we look at the monthly chart of the S&P 500, here's the head and shoulders again. That takes us back to this trend line. If we take the trend line from the bottom at 2009 and you connect it, excluding the shadow here from the pandemic sell-off, then again, you have this nice looking trend line, and that takes us to the 200-week moving average towards the 50-month moving average. This is the monthly chart. And again, if we come back down to this level, you've got a really nice looking head and shoulders. And again, the pattern would measure to take out the 2022 low and moving back towards the pandemic low. I think the S&P will drop more than 50%. The last bear market, it dropped 57%. The bursting of the tech bubble dropped 51%. NASDAQ with the bursting of the tech bubble dropped 83%. Kicked off the bear market with a 40% crash. If we do that, we're going back to the 200-week moving average on the NASDAQ. This is what it's done in the past. So I think it's reasonable to believe we get a bigger sell-off than what we had in the first part of 2025, a bigger sell-off than the 21% sell-off. I think it's reasonable to believe we move back to the 50-week right here. That's that green line right there, a little hard to see. But the 50-month moving average, I'm sorry, did I say week? 50-month moving average and the 200-week moving average in the weekly time frame. Now, again, we had the bottom over here in 2009. You got above the 50-month moving average. You found support at it, just like the 200-week moving average. It's acted as support. Here we slightly violated it during the pandemic, got back above it, acted as support. Here in 2022, it was support. We moved back to it in 2025. It was support. And again, in order to have a bear market, you got to take out this 50-month moving average and the 200-week moving average. And again, they're very close to one another. But you're probably moving back to the 50-month moving average. You'll probably take it out just like the 200-week moving average, and then you'll probably bounce and get a right shoulder. Now here, I have the right shoulder a little bit lower than the left shoulder. Could be that way, or they could be very, very close to one another. I've continued to warn about the monthly charts. You've got this negative divergence on the price oscillator in the monthly time frame. Right now, the S&P is down 237 points for the month. It's already dropped nearly 6%. NASDAQ over 8%. We're down in the monthly time frame nearly 3.5% at the moment for the monthly chart. We're going to have these monthly closes here in the near future, where as we wrap up the month and get past Thanksgiving. So again, we'll be watching to see if we begin to move back down here by January, and again, then get a right shoulder. But the 50-month moving average and the 200-week moving average, these levels have to be taken out for the bigger sell-off. Now, I've marked a 65% sell-off here. I think we'll get a bigger sell-off than the previous two bear markets, 51 and 57%, because I believe S&P is now NASDAQ 100 Junior, and I think it will get a bigger sell-off, and I think it'll be around 65%, maybe more, maybe a little bit less, but something in there. I think you're going back down to here and towards the pandemic low, and that would be a 65% sell-off. If you get something bigger, you could take it out. If we get something really big, you're going to go back here to the 1575 area, which is the previous highs of the bear market. That's this line right here. The previous highs of the ending the previous two bull markets. But this is the area where I think we're headed back down towards. I think that'll be into likely into 2027 somewhere, maybe the first half of 2027 or the second half. And then I think you're going to get a new bull market. But pay attention to the 50-month moving average and these head and shoulder patterns that I've been talking about here with the monthly, here with the weekly, and here with the daily time frame. About these divergences on the monthly chart, and again, you've got it on the price oscillator, the larger divergence with the 2022 high. You got the stochastic rolling over in the monthly time frame. If you just looked at the MACD, you would never know it. You would never know it. The MACD's moved to new high. There's no divergence present. It's at an extreme. That's the only information you get from the MACD here. It's going to be the lagging indicator. This price oscillator is going to roll over long before this MACD, just like on Bitcoin. Oscillator nailed the top. Bitcoin, the MACD is just barely rolling over here after a 6% decline. Got to confirm a bear market monthly time frame on Bitcoin. But again, I've talked about these warning signs here on the monthly chart. We do have a divergence with our previous peak back over here that gave us the 2022 top. Remember, we just had that Dow breakout to a new high. Everybody, oh, it's a breakout! I told you it's a fake out. We're going into major resistance in the weekly time frame, and the Dow is forming negative diversions here in the monthly time frame. You can see it down here at the price oscillator. Again, stochastics rolled over, forming its own diversions. So again, this is all warning you that, again, we're likely headed down towards the 50-month moving average. We're likely headed down towards the 200-week moving averages. Again, here, the 50-month has acted as support all the way up. You're likely going to come down to it and eventually break the 50-month moving average, break the 200-week moving average. All kinds of warning signs. I told you the Dow is moving to new highs to disguise that we were getting distribution. With the tech sector, we're getting the AI bubble bursting. They're going to sell off. We're going to see things sell off, and then they're going to run it back up so they can sell some more. That's why we're going to likely see these head and shoulder patterns begin to play up, and you got the same pattern here on the Dow. But this is, again, the Dow slamming into major resistance in the weekly time frame. This is extremely bearish, these divergences that are forming in the monthly time frame and in the weekly time frame. Just quickly, look at the Dow weekly chart. The Dow weekly chart, it's got the negative diversions going on. Oh, with the breakout, it was so bullish. And as it's slamming into major resistance, our channel from the 2020 low. So linear scaling. Got this log scaling with a rising wedge on it, again, from these previous lows right here. If we actually connect the 2020 low with the 2025 low, you got a massive rising wedge turning off of that trend line. It's a breakout! And I told you, again, that was Kool-Aid for the herd to trick them into believing the rest of the market was going to go make new highs. It's not. Stock market has peaked. We've begun the bear market. People don't realize it yet, and we're moving quickly towards recession. Nevertheless, I digress. You've got this channel here. And hang on, let me fix the trend line. I love these charts, but you hit save on it and the trend lines move on you sometimes. And if you lock them into place, they don't move with the chart. So it's kind of annoying, but they are nice looking charts. But nevertheless, I think you're going to move down here and again towards horizontal support and maybe even reach this lower boundary trend line as we drop into January or come towards this 200-week moving average on the Dow. You got the MACD rolling over this week. We've got a rollover now. You've got the rollover here on the price oscillator, which has a nice divergence, much better than the MACD, which is based on moving averages or stochastics still dropping and having its divergence with the RSI having the diversion. So again, everything is set. Maybe we get a Thanksgiving bounce, but I'm telling you, you take out those 20-week moving averages that we're trying to bounce off of, then again, we can get the drop immediately. You might get a short-term bounce. We're seeing the weekly charts turn bearish, and we're getting confirmation and a follow-through to our reversal bars in the weekly time frame. Here at the Dow, you had a topping tail here in the weekly time frame, and again, things are going to move because I'm bringing it up close, but you did move higher on the Dow. You got a topping tail. Remember, I talked about all that last week, and then you're now confirming that topping tail. Now, maybe you get a bounce with the holiday surrounding that, but now we're going to likely see the Dow do what NASDAQ and S&P have done and get a confirmation and then get a follow-through, eventually closing below this week's low. This is not a bullish candlestick. Slamming into major resistance and turning off of it. And again, the trend line did move because I brought it up super close so you can see it. Just be aware of all this going on in these weekly and the monthly time frames. Dow weekly here. Time frame, you look at the 100-year channel here. If you take this low and you come up here and you draw a parallel boundary to this high in 1929 with the 1929 crash, and you draw a parallel boundary from this low to this high, you're slamming up into it right now. That's what's going on with the Dow hitting those new highs. You're slamming up into it, connecting the low after the crash of the 1929 crash to the high of the 1929 crash. With the Dow hitting the new highs, you're slamming right into that upper channel line from the high to the low there of the 1929 crash. Same thing here with the S&P 500. Long-term monthly chart. You connect this low to the higher low right here after the crash. Parallel boundary to the 1929 high. You've slammed right into it. Again, the 100-year channel. As I've talked about, my Elliott wave count, long-term Elliott wave count, again, you're slamming up into the upper boundary of this channel. I think that you're completing the cycle top, as I've talked about in the daily time frame, and completing the super cycle and the grand super cycle and all of that here. And I think you're going to get this push down that's going to be a massive ABC move for the next two bear markets. And I think eventually you're going to come back to this 1575 area, the previous highs of the bull markets, and towards this trend line right here. And that's where I think that we'll see prices move probably in the next bear market. I think this one goes down to just to the pandemic low or just beyond it, maybe to this midpoint of the channel here. But I think you're going down below the 2022 low, and I think you're going down test the pandemic low or either get a higher low above it or take it out. But this is what I think long term is going to happen. Valuations are telling us that to expect something like this to happen, where you're going to have low returns over the next decade. That's what the Shiller PE ratio is telling us. High valuations with the Buffett indicator. The valuations are telling us the market is more expensive than any other time in history, and to expect a couple of crashes, a couple of bear markets in the next decade. And again, that's what you had back over here. These two bear markets in 2000 and 2007. You went nowhere for 13 years. Over here in the 60s and 70s, you went nowhere for 16 and a half years. Over here, after you peaked, you didn't make new highs until 25 years later after the 1929 high. The valuations right now are telling us to expect that. So I think you have a bear market going into 2027 or something, and then I think get a new bull market going into the 2030s, and then I think the debt bomb's going to explode, courtesy of the politicians that spend, the politicians, they spend like drunken sailors. And again, this is eventually going to create a depression. You cannot do what they're doing, running these $2 trillion deficits every year and not have a financial crisis. That's the next crisis. The one we're going to have right now, coming up right now, that's starting right now, is the banking crisis, as the commercial real estate crisis spills over into the banks. And again, the Fed is pouring money into the banks right now, trying to stave off a banking crisis. They're not going to be successful. It's going to be the next crisis, or it's going to be this crisis. The next one is going to be the debt bomb exploding, and the politicians are going to create a depression for your children and for your grandchildren, because neither political party has the moral courage to do the right thing and stop the crazy spending. But that's going to give us a depression in the early 2030s, 2030 to 2034 or so. They can do accounting tricks to drag it out a little bit. That's why I have that larger 4-year window. But eventually, that will be the next bear market. You're going to get a bear market here, a bull market that will follow going into the early 2030s. Then you'll have the debt bomb explode, and you'll see another bear market. But again, we're hitting this long-term upper boundary of the channel, and I think you have, the wave count completing here. I think you've got a 1, a 2. I think this is a massive wave 3 going from the 1940s on into the 2000 top, and then I think you got an ABC for 4, and then I think you've got this 5, and I've counted this as a 5. Now I'm looking for a massive ABC move. I think that's why I believe the top is in at these trend lines here in the monthly time frame and in the weekly time frame, as I went through the weekly channels in my last video. I'll link that at the end here of this video if you didn't see it.